So can everyone hear me loud and clear? Everyone have a pen and paper to take notes with. All right, I'm stoked to get started. So thanks for being here. Audio and video is working, fantastic. All right, so if you've been to any webinar with me in the past, thank you, and awesome to see you again. I see a lot of familiar names, that's awesome. You know I'm gonna be dropping some big ideas, and I know you are ready. All right, so first timers, excellent. So first time folks, excellent. Well, thank you for being here, for sure. All right, so welcome. The key is under this mat. Yeah, where is the mat and where is the key, right? All right, welcome to Market Money Math, the key to steady growth of a new trader's account. Now, it's not just new traders. We're going to get into a lot more of what this Market Money Math is. The key, let's start with the key here. Overcoming obstacles and opportunities. Can I increase the volume? I think. All right, we have the audio and video. All right, I'm just going to go on here because I think sound is good. Excellent. Thank you, Darrell. All right, the key, overcoming obstacles and taking advantage of opportunities. Gang, the key to steady growth applies to all markets. It's really been the focal point to my entire career. For those of you who don't know me, I'm happy to say I've beat the odds and have been a retail trader for over 30 years. Needless to say, I've seen a variety of market conditions. I think a lot of you have too, especially this week. And over the years, I've developed a consistent strategy to stay in the game. So over 3 decades, you see a lot, and I'm going to share quite a bit of that with you guys here today. So we're going to talk about how I've managed my capital and how you can manage yours through any sort of financial and market condition, in any size account, and in any asset class. All right. So next, and again, yes, this is being recorded. All right. Okay, so tonight I'm going to share with you how I've managed my capital, how you can manage yours. And we're going to focus on not just a single asset class, gang, but again, any size account, any asset class. All right. There are always going to be things that us traders and investors are going to have to overcome. Fear, time restraints, lack of capital, market volatility. However, there are always going to be ways for opportunities to be taken advantage of by traders and investors who know how to see through the greed, the fear, the panic, and use the numbers to their advantage. I think that's especially applicable right now. We're going to talk about tonight is not going to be a replacement for strategies that you may currently be using and love. I mean, keep them. I'm fully encouraging that. What we're going to do is make them more effective, better executed. What we're talking about tonight is how to appropriately position a trade before you even decide to take it. Again, how you can appropriately position any trade before you decide to take it. All right, do any of these situations feel familiar? Despite some wins, your account always seems to be in the red. Are you riding that P&L roller coaster in your account? Big win, big loss, bigger loss. Have you blown up an account? Maybe more than once. Are you trying risky home run trades in an effort to get it all back? Do you trade a big winner only to give profits back? Yep. Yeah, I see it. Are you looking into my crystal ball? We're going to work on all that there. You have some great indicators and strategies, but can't get them to grow your account, right? Anyone say yes to all those? I think we've been there. So let's stop the yo-yo trading now. Have you been watching me I think we all go through a very similar cycle. Yeah. So let's stop that yo-yo trading now. Are you ready to break these cycles? Can you do some fourth grade math, arithmetic even? Gang, for the next hour or so, let's shift our thinking from looking for the next big win, the next home run, to a couple of simple questions. Am I focused on my process, and am I controlling risk with each trade? We break the cycle, this yo-yo trading cycle, with simple math, market, money, math. I know math can be a four-letter word, but stick with me. It is not complicated. Now, it's interesting. If you put two traders in a room, successful traders in a room, the conversation is inevitably going to get to position sizing and minimizing risk, to position sizing and minimizing risk. Ironically, most traders don't end up properly positioning their trades, and that's going to stop tonight. Market money math is the approach to manage your money in any account from 5K to 500K. Doesn't matter the account size, gang. So why market money math matters, other than my love of alliteration, obviously? Because we're talking about the only uptrend that matters, your P&L. Even if you win more than you lose, if you invest too much of your capital per trade, drawdowns will take your account underwater. Ultimately, your account will blow up. It's simple fourth grade math. Again, if your drawdowns are too great, you're going to drive your account underwater. Market money math shows you how to properly position your trades for steady growth in your account in any asset class: futures, options, ETF, Forex, doesn't matter. All right. What are the keys to success? The symbols may change. The instruments you trade may change. However, gang, a successful process will not change. Market money math does not have to replace any tools or strategies that you're currently using. Market money math is an addition to your current trading tools to define proper position sizing, risk levels, and your watch list itself. This is one a lot of traders don't think of. Market money math actually helps you develop a better watch list, what you trade and the groups of trades that you enter. So there's three key principles to know, all right? Number one, how to position size relative to your stop loss. Let me say that again. How to position size relative to your stop loss. In other words, what is your risk on the trade? That's how you position size. Number two, what specific entry level you're going to use for your account, right? There's multiple entry levels, and we'll talk about that, but what specific entry level are you going to use in your account because of the risk on the trade? Number three, how to group your trades based on trends. That's really something that is always going to be an advantage, gang, focusing on those market trends. So the goal of market money math is this: to create consistent positive results despite different events. We saw a major one. They're not going to stop anytime soon, gang. We want to understand the numbers behind the trade. What are the numbers behind the trade, gang? Risk, reward, volatility, time, price, capital, right? We've got to work the numbers behind the trade, and that is the process. Yes, you can trade volatility successfully. We'll show you some examples here today. There are multiple volatility events, different types that we will have, and we'll have to learn to manage. This applies to any size account from 5K to 100K, gang. There are expected volatility events. Think about earnings, economic data, central bank events, options expiration. We're actually putting in a pit bull low environment right now. These are events that are on the calendar, right? These aren't surprise, they're scheduled, they're on the calendar. And the market has time to brace itself for them. This is actually called discounting. There are unexpected volatility events that are complete surprises. There could be a surprise event from a company, geopolitical events, weather events, tweets, right? Tweets. things that the market could not see coming, could not brace itself for. And when those events happen, these unexpected volatility events, adjustments are made swiftly, even mercilessly, with large volume. So volatility can accompany certain times of day, by the way. Wall Street open and closes, as well as the third Friday of each month, of course, with options expiration. All right, so different kinds of volatility. We have to know how each affect our trade. All right, let's talk about some trades, shall we? Let's jump into bonds here. Over the 2 days of Jerome Powell, the head of the FOMC's scheduled testimony, what's known as Humphrey Hawkins testimony, we bought calls. We sold one call and made $640 in just 11 days. As of today, this is still an open trade with a profit of $1,685. And what you see there is right from my platform. Let's take a look at the chart. So here it is. You can see where the buy is. That was the 2-day Jerome Powell event that we took advantage of. So who's ready to make 60% return in your account in the next 60 days? It's actually right now, we're sitting at 77% in the last 70 days. Yes. All right. So I'm going to show you how an account that has earned 60%, actually 77, sorry for the false advertising there. That's actually 17% more since May 30th. All right. Without ever risking the account. In other words, betting too large. With very low risk per trade every time, gang. It's a process every time, without trying to hit or even needing home runs, but still having a few, which is great. And in a pretty uncooperative market. What we're talking about is the only thing that ever matters, gang. Steady upward gains in your account. Steady upward gains in your account. This is a $10,000 account. Boom. 10K on May 31. 10K on May 31 is 17.7 today. A snapshot of the current account right now. All right, so what's going on here? What's the story? So near the end of May, my husband decided that he was ready to start learning how to trade. He quit his job about 6 weeks earlier, and we started him off with a 10K account. That's the account that's now valued at that 17.7. He had no prior trading experience. He followed just 2 setups and the market money math, risk controls, and position sizing, and the watch list that we're going to talk about tonight that I've developed over the last 30 years. And he's now up and running in what we refer to his 10K to 10X account. That's the goal. Nice bike. Yeah. So the other day I catch him looking at Ducatis. He's pretty sure he's going to be buying a new Ducati before Halloween. That's his goal. And yes, that means he will have doubled his account or better since May 31. Not too bad for a new trader. And, I have to say, he had a heck of a teacher and market money math. So yeah, that's the Ducati. They're gorgeous, aren't they? So everyone needs market money math. Market money math is not just about new traders or even traders struggling to achieve account growth. It's also for traders with stagnant account growth, traders who want to accelerate account growth without unnecessary risk. It's very, very simple arithmetic, gang. I'm even embarrassed a little bit to say I took college algebra twice, and not because I loved it so much. So it's not complicated math, all right? Gang, think about this for a moment. Even if you win more than you lose, in other words, you rely on a high win rate. If you invest too much of your capital per trade, drawdowns will take your account underwater. Ultimately, your account will blow up. So why that happens? You're overcommitting capital. It's a major issue, and it's likely keeping you from a consistently positive, upward sloping P&L. That's the goal. Every day I look at my account and I think, all right, how do I get that P&L sloping up? So what's the game behind this? Understanding the game. Whether you trade futures, options, ETF, Forex, heck, even crypto, whatever it may be, your account could have been up 60% in 60 days by using market money math. In this choppy summer trading season, which is exactly when this trading was done, again, May 30th. This is about consistent, steady gains by doing the fourth grade math before you take the trade. Emphasis on before. It's your job, like a batter in baseball, to get on base, right? Great trading is no different. I'm a huge baseball fan. How many folks here love baseball? Warren Buffett loves baseball. Buffett's a huge baseball fan, and he knows his market money math. All right, so it's a quote from the man himself. What's nice about investing, now he's talking investing, but the math applies, gang, is you don't have to swing at pitches. You can watch pitches come 1 inch above or 1 inch below your navel, and you don't have to swing. No umpire is going to call you out, and you can wait for the pitch you want. Emphasis on that last part, gang. Warren Buffett himself. The pitch is your market money math, gang. The pitch is your market money math. So we do not want to rely on home runs, okay? They are actually the most common reason people do not grow their accounts. You should not be walking away trying for home runs. You're going to consistently strike out. I mean, listen to Mr. October here, Mr. Reggie Jackson. Home run hitters strike out a lot. Sadly, that is exactly what most traders and investors do. They risk too much. They lose too much, and then rinse and repeat, right? Trading is about consistently, steadily growing your account, smooth, upward, P&L curve, right? Market money math, again, otherwise known as some fourth grade math, gives you the process. That's what we want, that process that is repeatable. All right, so how do we hit consistently? And I think I've gotten across the point that we want to hit consistently. So let's look at one of the basic setups that I used in this particular account, Disney. It started, as every trade should, with the market money math. The trend was up. The timing was pre-earnings. How about risk? This is the fourth grade math anyone can use in any size account. So why listen to me? All right. Because I know how to wait for my pitch. And that's what I want you guys to know and have the confidence to do too. I know how to get on base. Just get on base over and over again. So, right. And now you're going to learn how to do that too. So let's take a look at this particular winning money math example. This is Disney. All right, so that's the trade on Disney. These are taken right from that account. You can see the position size, what we bought. So we bought calls on July 19 as Disney sunk to 140. The September 20 140 calls cost $5.23. We bought 2 of them. On July 19, we bought them. On July 29th, we sold them for $8.75. That's $3.52. So again, across those 2 calls, it was $705 in 10 days, $705 in 10 days, getting on base, right? So let's take a look at the chart so you can see how we did this. All right, so this is the chart of Disney. And let's break down this simple setup just a bit. All right, let me explain very, very briefly what you're seeing on this chart. These color codes, color-coded candles and moving averages are how I identify market trends, momentum, volatility, price ranges for our exits and entries. These are baseline tools that I use for every trade, gang. This is my touchstone. I'll be talking about this further a little bit later on towards the end of the presentation on how you can get these tools. Just make sure you stick around. But market money math does not replace any indicators that you might be using right now. These are the ones that I use. This is an add-on supercharging your trading plan, position sizing, risk control, watch list building. The concept behind this setup is as simple as I'm about to explain. Don't overcomplicate the indicators. It's color coding trending. That's it. All right. The 3 lines, the green, the red, and the blue running across the screen right now, that's the 34 EMA. And the candles plot, the colors of the candles plot based upon the location of price in relation to these moving averages. Okay, so you see the 3 moving averages here, and then the candle colors plot based upon their relationship to them. Those moving averages are the 34 period exponential high, low, and close. And these colors are the simplest way to identify the market trend of any chart. If the candles consistently plot green, the market sentiment and likely the trend is bullish. If the candles are blue, the market sentiment is neutral. And if the candles are red, the market sentiment and likely the trend is bearish. In just a little bit, we'll talk about how you can get all these tools and learn how to use them. They're not required, and they're not going to replace anything that you're already using. I just want to make sure you have the same tools that help build this 10K account and know what they do. All right. So that's the point there. So again, what do we do at Disney? Disney is the chart that yielded $705 in just 10 days with those two options. This is how powerful trend trading plus the money market math can be. Proper position sizing with controlled risk in a healthy trend is a repeatable setup. It's the one that we repeated over and over and over again in this account. Add the tendency for an uptrending stock to want to rally into earnings, and that's what gave this the potential to be a big winner. Disney is an example of great balance of size. Remember, we took just two options. Okay, again, think about 10K and the size we took with just the two options. So we balanced size and risk to the account, as well as risk of the trade. The first step was to define the range. Okay, so we talked about the range that we're looking at. This specifically is the range for this trade. Let me highlight this here. So this specifically was the range for the trade. So the range was 141 to 139. It was a 2-point wide range. The upper half of the range was 1 point wide from 141 to 140, and the lower half of the range was 140 to 139. So the first step is to identify the range, right? As we go through the market money math. I entered in the lower half of the range, which allowed me an entry closer to the stop loss. We entered in the lower half of the range. And this allowed me to buy more options and risk less. So again, we waited for a more conservative entry. The validity for the trade is just below the lowest price of the range. So again, tight stop. And by the way, the validity is the price at which the trade is no longer valid. So when I refer to something like validity, it is not dollar or percentage based. It's about where the trade is no longer valid. And for this setup, that level was 138.90. Okay. The second step is to find the correction. We always buy in a pullback. All right, we always buy in the pullback. So let me show you what I'm talking about here. So here's Disney heading higher. Boom, there's our pullback. By the way, here are those two zones I talked about right there. All right. In this case, our entry triggered on July 19. So we bought the 523s, $5.23 on July 19 for those calls. We sold them for $8.75. That was a 705 in 10 days. So you can see the subsequent move to the upside. All right. And again, that was pre-earnings. We used earnings as you know, we benefited from the volatility pre-earnings. The maximum allowable loss, and for those of you wondering about the math, here we go, gang. The maximum allowable loss to the entire account, the way we built this trade out, was 2.5% of the account value, which allowed me to risk approximately $250 before I'd have to reconsider and or exit the position. In other words, reconsider meaning, you know, why is the trade moving against me? Is this something that, you know, we want to get out of? Is there something catastrophic happening within the trade? So we have the cost of $5.23 per option times 2. That was the 1046. 1046, risking 25% of that is basically $261. That's in line with my $250 max risk. And again, two options, roughly $1,000, 2.5% to the entire account risk, and 25% of the value of what we spent was all I was willing to risk. That's That's really the first step of the math. How much is this going to hurt my account? How much is this going to cost me? And how much can we allow the trade to move against us? All right. Okay. All right. So that's the summary. That's how powerful money math can be. Again, we're talking 2.5%, then using that 25% threshold. That's how we start. That's the initial start of using proper position size with controlled risk in a healthy trend. Disney was a healthy trend. And of course, we use that uptrend plus the rally into earnings to give us the potential for that big winner. So there's another look at the chart here, talking that math I just talked about. By the way, yes, this is being recorded, so you can review these for sure. All right. So let's talk about that 2.5% rule. It's actually 2.5 to 3%. It's my main guide because it allows me to prevent a single trade from being able to inflict significant damage. It allows me to measure what an affordable or appropriate entry level is. Now remember, we had thresholds for Disney. We also looked at 2 different entry zones for Disney. And because I took that more conservative entry zone, I was able to control my risk and take actually a bigger position. And here's the important part, gang. For those of you that have ever blown up an account, it allows us to avoid risk of ruin if consecutive losses occur. Now, I put this little graph here on the right to show you something that I think a lot of folks may forget. This is one of those slides that, when you get this, you might want to jot this down, maybe print it out, take a screenshot. Why? Because when you exceed, say, 50%, see that right there? When you've lost 50% of your account, think about what you have to gain just to break back to even. We should never be in a situation where we're at risk of blowing up an account. Once something gets to about 50%, gang, look at that. That's jarring. We want to avoid that. So as we say, we want to check yourself before you wreck yourself. Risk of ruin is a term used when a trader loses a significant amount of their account. For me, what's ruin? A loss of 50% of total account size. If you use that 50%, gang, you're not going to be blowing up accounts anymore because you have a point at which you will stop and reconsider what's not working. So again, 50%. That just means, again, if you lose 50%, just to break even on your account, your win rate would have to be near perfection. Okay, just to break even. So let's move on to a couple more examples. All right, so again, gang, 50%, write that down. I'm not gonna allow my account to dip below 50% ever again because I know the money math is stacked against me if I let that happen. All right, so let's talk about natural gas here. This is a beautiful trend. Again, we have a terrific advantage when that happens. So how did this natty gas trade work out? How do we set this up? So that downtrend in natural gas, you can play these trades, by the way, again, for those of you that may not trade futures, there is a natural gas ETF. So as you can see in this account, we use UNG. All right, so because we know how to properly position size our trade, we bought 2 October UNG 21 puts for $1.50. All right, so $1.50. Think about the math we've already talked about. If each were to go to 0, which is super unlikely with so much time to expiration, that would be a max loss of $300 to the entire account, $300. So it's certainly within our 2.5 to 3% risk. We'll dig deeper into this trade and account, but for now, the short story is this. The October 18 UNG puts are currently trading at 306. I think they actually might be a little bit better than that. This means that we made $313 on an initial 150. The risk to the account was 1.50. If it went to 0, which we do not risk, right? We're up 3% alone on this trade in the account. The trade was structured in such a way that despite the volatility, we limited the risk to a very low level. By the way, this was a trade that was set up during the tropical storm Barry that was heading up towards Louisiana. In fact, we took advantage of that volatility. This is basic level money math here. You can follow this fourth grade math in any account size. So we want to really prioritize this. This is a crucial part of your trading strategy. It must be prioritized. It blows my mind how many traders don't prioritize this. All right, so natural gas, now that you're on friendly terms with it, we just call it natty or natty gas. Here's the trade summary. We bought 2 UNG puts for $1.50. If each were to go to zero, again, very unlikely. The max risk was 300. Now, another thing I want to remind you guys about natty gas here, and even the choice of going with the option. We had a tropical storm, a very volatile market. So we controlled risk with the asset class. So think about that for a moment too. We have the percentages, but the asset class going with the options helped us control the risk. It was never intended to be a home run, but sometimes you get the timing in the trade perfect. We worked the upper end of the zone in this trade, and it was a big winner. Again, this was done in a relatively small account with an actually very volatile symbol, natty gas, super volatile. But again, we controlled the risk with size, our threshold, and using the asset class of options. All right, so let's break this down a little bit on natural gas, because this is a great example of how to control risk. So the market trend, as you'll notice, was down. Look at all the red grab candles. It's predominantly red, so the market trend is down. The volatility, which presents mostly a challenge to maximum loss. Again, we protected ourselves with the options, right? So we set this up as a very risk-controlled trade and ultimately a winner. So nice downtrend. Sentiment is bearish. We have the color-coded directions with the grab candles. In an environment like this, we are going to set up shorts on bounces. So we waited for the bounce, right? So that's where we bought the puts in this area. In this case, the bounce came with volatility and exhaustive volatility at that. So when we have exhaustive volatility, again, that's part of how we know the market's likely to stop. There's a typical price movement range associated with a lot of markets. We take advantage of that. That's the math. So in an overall downtrend where the red candles outnumber the blue, outnumber the green, we know we want to short. Natty gas bounced or corrected on July the 5th, in large part due to that storm that was heading towards the coast of Louisiana, which by the way, is where a lot of the processing for natural gas takes place. The volatility was an overreaction. And you can just look at this candle right here, this candle right there on the 5th. The range here is 235 to 250. That was our range. So 15 cents between 235 and 250. That's one part of the range, but then the upper part of the range, the lower risk money math part of the range is 240 to 250. When you work with the range that is closer to your stop loss, you can consider larger position size and a smaller stop. Okay, so this is a storm-driven rally that drove it to the upper end of the range. That panic was what we took advantage of. So what's the lesson here? Right? We're seeing a lot of panic in a lot of markets, aren't we? What's the lesson here? When there's panic in the market, let it happen. Don't jump in right away. Okay, the entry range begins at the 34-period exponential moving average on the low and extends to the 34-period exponential moving average on the high. When volatility is like this unexpected variety, this case tropical storms, it doesn't matter if it's a tweet, doesn't matter if it's a soundbite, whatever it is, when it's of the unexpected variety, like the one that shot natty gas up higher, we control with the asset class. So in other words, again, instead of shorting natty gas futures, we bought the puts on the UNG ETF. That's how we controlled risk here this time. So it quantified the risk, the maximum risk to the total amount paid for the puts. So we went long puts. So even if I was very wrong and the market just rallied because the storm perhaps was more impactful, again, we have a premium tolerance, which is 50%. We have an account tolerance, which is 2.5%. And we have also, again, this asset class that allows us to control this overreaction. All right. That's natural gas in a lot more detail, what we took advantage of. And again, this was the kind of trade that's set up with the unexpected volatility. And the better you get at managing unexpected volatility, managing that risk, the better you're going to be able to manage really the rest of this year. And anytime throughout your career, gang, when the market throws you something out of left field, right? All right, so let's talk about the NASDAQ. This is a great trade. That triangle there is one of two recent buys. Notice again, the candle colors. This complements the 34 EMA wave, and it keeps me from shorting. Green grab candles, you focused for buys. And we are going to go with the dominant trend. Again, green grab candles, the sentiment is bullish. This one was great. This was $1,611 in 11 days. Why? Simply, we're waiting for these kinds of moves, gang. All right. So let's talk about a little bit more detail on this NASDAQ trade. All right. So we bought calls on the QQQ. So notice the color of the candles. Those are the ones that complement that 34 EMA wave. Kept me from trying to fade the highs, kept us on the side of the trend. When the trend is up, it's the pullbacks that we're after. This is a key part of the market money math, gang, that we use to find the zones. All right, so we talked about upper and lower zones. We do the math on each zone that helps us determine the position size and ultimately the impact on the account. Notice it's not a singular entry level, gang. I'll have anywhere from 2 to 3 zones that I'll do the math on. The QQQ calls were bought on the pullback on May 31st and June 25th. The May 31st entry was held for 18 days and made $1,282. The June 25th entry was held for 15 days and made $392. And I want to dive into one more thing here because we took this S&P trade at the same time. It was a complementary trade. So rather than just digging down and buying more QQQ, we spread it out, smaller trades across more symbols. So the SPY trade was taken, which is sympathetically going to move with the NASDAQ. It was another $1,656. Microsoft was entered as well. It was another, I think it was what? Microsoft was another 634. So what we did is we scaled our win. It's a scalable mindset. We scaled our win here. We're not building a trade deep. We're going wide. So this is how market money math with a trend creates possibilities for bigger wins and reduces the risk of ruin. We're not diving into one symbol and we're not betting big on one symbol. Again, we're going deep. We're going wide, not deep. So we'll also take a look at a handful of trades from this account, similar setups that allowed us to steadily build this account from that 10K, which we're up currently about 77%. Okay, so how do you supercharge when you have a trend moving in your favor? So this is that complimentary Microsoft trade, $635 in 10 days, right? That went along with that overall NASDAQ. Again, exactly. We want to spread the risk because think about it this way, gang. We don't know what the leader or the laggard is going to be. We don't know who's going to emerge as an outperformer or underperformer. Money math presumes that we don't know what's going to happen, and that's the truth. But by, again, building wide, not deep, and doing the math on each individual trade while respecting the trend, that's how we supercharge this stuff. What else have we done? Well, let's take a look at McDonald's. This was a very recent trade. We bought September 210 calls for $565. We just sold those for $980, $830 in 4 days. What did we do? We did the math. We identified the zones, how much risk is in, let's call this the high zone and the low zone, how much risk per each zone. If we want to keep the risk lower, we focus on the lower zone, which is exactly what we did. And so again, that's how we can control risk. And we take advantage of a trend, gang, the overall flow of the market. So this was 830 in 4 days. Love this relative outperformer in McDonald's. All right, so these are a handful of closed trades in the 10K account. As I mentioned, we were up 50 in 50 days, then we were up 60% in 60 days, and then right now we're 77% since May like 28th, 30th. Okay, so I want to point out a few things on this chart. I break down the trades. It's the small drawdowns, gang, that help a P&L slope move higher. I know that doesn't sound sexy. We like to talk about big winners, but it's actually the risk control and the position sizing that help that P&L slope higher. Now, win rate, yeah, about 86%, but look at the average loser. That's actually really what we want to focus on. Are our losing trades hurting us, or are we able to manage them? Okay. Awesome numbers. Yeah, I agree. And you're going to learn how to do this because it's not complicated. So since the end of May in a 10K account, this is a snapshot from today, gang, including the roller coaster ride that we've seen this week. Working the math. All right. So let's face it. No one wins all the time. All right. That's true. We do have, we lost, right? We took a trade in crude oil. It was a losing trade, but with the market money math, the loss was actually about 1% or $95 on that trade. Let me show you what that trade looks like. All right. So the market money math saved me from this trade being a big loss. Now, this trade did go the scenic route. It was a tough one to manage. No doubt about it. Some of you might have remembered what this particular trade went through: OPEC, trade wars, the tropical storm Barry, right? So this one definitely fluctuated quite a bit. A lot of you know where crude oil is right now. So sometimes, yes, we want to be able to take those quick losses. We can free up capital and just look for the next opportunity. So yeah, we do lose, but we keep it really, really small. We protect ourselves. All right, so let's talk about the first trade in this account. It's kind of funny. So some of you might know this is an account that my husband's been trading. So when I talk about something that new traders and experienced traders alike can benefit from, and my husband's probably not going to appreciate my sharing this, but it's really, really telling of where he is, and again, using the math, how he saved himself from kind of a silly little error. He clicked the wrong button. He clicked the sell button in his first trade instead of the buy button, which actually ended up being a winner, but for not for him, right? He did the most newbie of newbie things. He sold instead of bought, right? So chalk up his first trade and his first loss, but it didn't hurt him because as he watched the trade go against him, he knew the market money math. He just happened to be applying it to the wrong side. But again, he knew what the thresholds were. Right? I think we've all done that, right? So this account that's up 77% started very unceremoniously. And I think for a lot of traders, it might have killed their confidence, right? But because he stuck with the process, because he stuck with the math, I mean, it didn't, right? Good student, exactly. So let's notice a few things about the market money math. And first of all, the reason the word market comes first is we're talking about a portfolio of open trades, going wide, not deep, not looking for home runs, not overcommitting to single trades, and also reflecting the major market trends, which you now know how to identify with the grab candles, right? Red and green, those are going to be your best. Dominant red, dominant green, those are going to be your best charts to focus on. Second, no single position. This is huge, gang. No single position was large enough to be a grand slam. We're not going for home runs. We're not going for grand slams because we know we want to avoid that risk of ruin. Grand slams and home runs feel great, but what's on the flip side of that? As our friend Reggie Jackson said, home run hitters strike out a lot. So it's not enough to simply go for wins. It's going for market money math wins, smaller positions across multiple markets, working on a theme. Okay. So remember, a 50% loss of your account value requires near perfection just to get to break even. The third thing we want to accept is that we talked about before, we don't know which trades are going to be, which particular markets are going to have leaders and laggards. We talked about that NASDAQ trade, whether that's NQ or QQQ. We also had the S&P, and then we also had Microsoft, right? So again, wide, not deep. We don't know what the leaders and laggards are going to be. So we build multiple smaller positions. And here's something that I do a lot of. And if I put this on a sticky note, I had it on a sticky note for years. Pay yourself while you can, not when you have to. We have to take profits proactively. That's how you get to a return like this, gang. Okay, we take profits consistently. You're not looking for home runs and grand slams. Okay, so let's talk about some growth rules. Some growth rules at a glance. All right, so the rules are the same for 100K as they are for 10K. They're the same for beginners or seasoned traders. All right. I love this first one. You've got to let the probabilities play out, gang. One of the most disheartening things a lot of traders do is they grade themselves each week, each day. Give yourself a week, give yourself a month, let the trades play out. Okay. You have to know how to select low risk, strategic profit targets. Again, pay yourself while you can, not when you have to. And please keep this in mind. You know, whenever you start thinking about, you know, wanting to hit for the fences, think about what if you were to lose 50% of your account, what you then have to do. Near perfection. All right. You can choose trades that capitalize on volatility events. That's another thing that we've talked about here, whether it's a storm, whether it's earnings, whether it's scheduled, whether it's unscheduled. Volatility events are one of the biggest risk of ruin events to any account. So we want to, one, brace ourselves for them with smaller account size, again, going wide, not deep, and utilizing them when they're of the known variety. Like the bond trade earlier with taking advantage of Jerome Powell. And we also want to utilize the asset class. This is where stocks, ETFs, and futures options can allow us to control the risk so we can withstand that volatility. All right. So what about position rules at a glance? The best positions are built on sort of larger sectors or themes. Again, we go wide, not deep. Entries are always going to be across a couple levels. We talked about the high and low level on a number of those trades. The lower level is going to present less risk. Trades are always built from the stop loss up. We're thinking about risk first, then we're thinking about profits. We want to scale out of trades and move stops to break even. That's something that a lot of traders don't do. Okay, when you hit an initial profit target, like our bond trade where I said we're still up very nicely, we didn't exit the trade. We took some profit and moved a stop to break even, and then we see how high is high. And while we don't aim for home runs or a high win rate, if you try to do that, you will lose. We still get home runs. We still have a high win rate, but we're not gunning for that. All right, so a couple questions to ask yourself here, gang. All right, so no matter what your account size, 5K, 10K, 50K, 500K, no matter what you trade, futures, options, ETFs, stocks, bonds, no matter how long you've been trading, 3 months or maybe 3 decades like myself, there are a few questions to ask yourself. Do I want to learn how to risk less money while growing my P&L? Who doesn't want to do that? Am I consistently on the right side of the trend? Think grab candles, gang. Am I ready to stop risking it all to get back to even? That's a big one. Am I trying to hit that home run just so I can get back to even? Am I ready to stop trying to hit those home runs and just get on base like I've shown you we've done here with this 10K account? Small trades, small wins, again and again with the trend. Would I like to have a proven approach that can be repeated on every trade? A proven approach. It's doing the math, gang. If you answered yes, you're in the right place. The markets over the last few days or even the last few weeks have been really punishing traders who don't manage position size. I think we've seen that most especially on Monday. You trade dangerous watch lists or you bet too big on a single trade. That is not controlling your downside. Think about the 2.5% to 3% and the 25% threshold to keep yourself out of trouble. Remember, if your overall account size shrinks to 50%, stop, right? Because you know what you have to do just to get back up to even, right? So we have some numbers that you can now focus on. So what are the answers? You know, how do we build trades like this consistently? All right. So we are going to be doing a class on August 17, a 4-hour strategy class from 11 a.m. to 3 p.m. Eastern. In this class, you're going to learn step by step how to apply this 4th grade math. You've seen a little bit of it here today, just some of those basic levels. Market money math, it's 4th grade math, is going to help your position sizing, trade selection, and your watch list. Stop risking more than you should. Stop trading the wrong size. Too large a position is actually a very common problem, but funny enough, too small a position is a close second. So you can trade too small too, gang. So when you do the math, what you're able to do is find that sweet spot in terms of risk and position sizing. So you want to start winning more than you're losing. No more blowing up the accounts. In fact, the money math, as we talked about, even that 50% threshold that gets you to stop is going to make sure that you can't. All right. So the basic package, as you can see here, is the, oh, hang on one second. All right. The basic package here, right here, is the strategy class. This is the 4th grade math. You're going to learn the process, the formulas for the entry zones, the stop losses, position sizing, you know, getting to that steady upward growth, right? No more yo-yoing in your account. I'm going to show you how you can do this and how it applies to any account size, 5K, 500K, in any asset class, whether you're a beginner, whether you're experienced, whether you're advanced. And by the way, you don't need but about an hour to do this. That's one thing I didn't mention. My husband's trading for about an hour, 90 minutes, maybe 2 hours max per day. All right. So the basic package is the strategy class and the market money math that we're focused on. All right, the pro package. This includes the 4-hour strategy class on August 17 from 11 to 3 and 2 days of live trading. So we're going to get together on Monday, August 19 and Wednesday on August 21 from 9 to 12. So 3 hours to put our new strategies to work in a live environment. All right. So no guarantee, but it's very common for attendees to win back at minimum their class investment during these live trading sessions. So this is 6 hours of live trading to implement your new strategies and we can walk through them together step by step. So as I mentioned earlier, this is where you can get everything I use for the color coding indicators we talked about earlier, because what we're doing in the pro and elite package is we have a bonus of decoding the swing trading, a deeper dive into those grab candles that I talked about, the color coding indicators. This bonus is free with the pro package and the elite. In a way, like an exclusive like this, an inclusive jumpstart like this before, but it's so important because this is really the foundation of what my husband used, that 10K account was built on. So I've used these indicators and these principles for 30 years. They are time tested, gang. That's what you're getting in the bonus. They're a basis for every trade I make. You noticed every example I gave you, we found the upper end of the range and the lower end of the range with those indicators, the 34 EMA wave. So this is truly bonus information, because if you're looking for a simple approach, this is it. Defining setups, the same type of setups that I use to grow the account, that's what I'm going to be showing you. So the indicators are included free, by the way. These are free indicators. And they're not required for the class, although I love for you to have them, because again, this is what we use to build the account. And so this is going to work with any indicator that you're currently using. It doesn't supplant anything that you've got. It's just going to help you identify the trades and execute the trades with the confidence that, you know, my husband actually gained with the color coded clarity. Super easy, no matter your account size, asset class, time frame, level of experience. That bonus really is a huge one. That's what we use to grow that account. All right, what about the elite package? So this one is 4 live trading days. So we're going to have the 4-hour strategy class and 4 live trading days plus the bonus. Okay. So that's 4 days of live trading. That's 12 hours of our looking at the markets together, building watch lists, building trades. So we'll get together on the 26th of August, and then again, what's it, the 11th and the 26th? I'll check the times. But again, it's from 9 to 12 Eastern. So we can get a few more 2 more days of live trading together. So you can come back with questions. We've spread these out, gang. They're not sequential days. We've spread these out so you can come back with your questions. We can see how the trades are evolving, and you've had a few days to practice the new math. Practice makes perfect, of course. So we're looking for that steady, repeatable process. So with the time between the live events where we sit down together, you can come on back with your questions and I can address them. By the way, it's $100 more than the Pro package. And of course, that includes the bonus too. So you get the 2 setups that we used in the 10K account right now, and we'll do the live trading together. All right, so a couple of the things here, gang. This really is about increasing your confidence. I've watched a new trader here in my office, right? This is my husband's account you guys are watching. The candles, the candle colors, the money math is what really increased his confidence to take him from really knowing very little about the market to having a repeatable process. So once you understand the process, you'll know what to trade. You'll know how to supercharge your trades while reducing risk. You'll know how much you can risk from an affordability standpoint, and then scale out, as I've spoke about, with confidence. Let me share with a couple things that a few folks had to say. So this is Robert. I want to share my account results with you. I started trading towards June 25th-ish. I love the ish. I now have 6 wins in a row in about 24 days. That's the stuff I love to hear, gang. I can't thank you enough. I was getting so depressed about my results. Please see attached. And yeah, he did send his statements. What I love here is that we know losing trades are coming. As he said there, losses will occur, but controlling risk is the name of the game, so the losses are small. Another person putting this kind of market money math to work. It was very difficult for me to develop a sense of direction. I decided to listen to a few of your evening videos. I immediately related to your approach, the flexibility it offers, the trading virtually all products, and a relatively conservative approach to charting. The grab candles in the wave, gang. So I've simplified my approach, enhanced my profitability significantly, and improved my win-loss ratio. I mean, what more are we looking for, right? What more could we want? So if you head on over to simplertrading.com/math, gang. The strategy class, again, on the 17th from 11 to 3, we're going to be discussing how to do the same thing in your account. It doesn't matter what your skill set is, gang, or the size of your account. You've got to understand what you're doing and why you're doing it. That's where the math is going to help. For the newbie trader, it's starting off with making good habits. I mean, that's really what we did here. Even when you hit the buy button and sell the sell button, you know, how do you make sure that trade doesn't get away from you and destroy the account? For the seasoned trader, it's probably going to help you break some bad habits. Or for a lot of others, you're going to look and explore things about position sizing and risk that you may not have actually thought about before. Bottom line, gang, we're setting up a repeatable approach so you can become the trader that you want to be. And stop getting motion sickness from your P&L. We've been kind of joking that we all need Dramamine on our desks lately with what's been going on. All right. We're going to take some Q&A, gang, here in just a moment. So sit tight. I will absolutely be taking some Q&A. All right, gang. So finally, we talked about the 2 live trading days. So again, remember the live trading days are an opportunity to practice what you're going to learn in the class. We will be sending out trades and alerts. So if you can't join me for all 12 hours of the Elite program or even the Pro, the 6 hours, we will be sending out alerts. I'll be sending out the watch list, the trades, and the alerts. So again, for $100 more, you can join me for 2 more sessions. So let's get to some Q&A here, gang. All right. So, all right. Sit tight with me, gang, and let's tackle some questions. If we don't trade options, can we trade futures? Absolutely. Absolutely. RB, what I'm going to mention though is we can trade futures, we can trade ETFs, we can trade options on them both. The asset class fluidity that I want you to eventually embrace, you don't have to be an options trader, um, but the asset class fluidity that I want you to embrace is going to allow you to control risk. So, for example, in that natural gas trade, yes, you absolutely could have traded natural gas futures. But what I'm going to say from a risk standpoint is what if that storm did hit? What if that volatility did not exhaust? It's much more difficult oftentimes to control risk in that underlying futures, and we can absolutely quantify it, avoid that risk of ruin by using the option. But absolutely, RB, you absolutely can. You're going to trade a little bit smaller size. Many contracts, by the way, have micro and mini alternatives. So rather than going into, say, full-size contracts, you can utilize the smaller futures contracts like micros and minis. Am I a seller or a buyer of these calls? They're all long calls and puts, SSS. Yeah, again, very basic approach. Long calls, long puts. I'll be talking a little bit about verticals in the class, but we keep it very basic. Now, for those of you that like to do debit spreads, put credit spreads, we'll touch on the timing of those particular entries, but we purposely kept the approach very simple. Long calls, long puts, and even trading the underlying futures or ETFs. But we're utilizing the margin, right? The margin of futures and or options, and also the relative safety of options on stocks, options on ETFs, and options on the futures. Okay. For any of the post-earning trades, do we still make those trades? Absolutely. That's a big part of one of the processes for the market money math, which is a process by which we start scanning 6 weeks out before earnings and start doing the math on the run, as we call it, into earnings. So yeah, there's absolutely a process for pre-earnings. Is there a process for post? You know, from a standpoint of risk, gang, I'm going to typically tell folks, like that Disney trade that we had, I'm going to tell folks to take their money and run, because the risk of, for example, we saw what happened in Disney. That was a $705 winner for us because we did not take the unknown of earnings, right? That would break the market money math. That would possibly break that threshold of the 2.5% to 3%. So we avoid those types of trades altogether. They're tempting to want to take, but that is what is that grand slam home run mentality that keeps your P&L from moving up steadily. Remember, gang, this particular account has grown 77% since May the 30th. Think about what we've been seeing since Memorial Day. It's been mostly chop and a lot of volatility, not that smooth, great uptrend that we saw earlier in the year. So I am going to tell you to keep the losses controlled by avoiding those high volatility events like earnings. Trade into them, but not after. Okay. Let's see. John mentions I took the McDonald's trade, held 4 days, 575 out. Oh gosh, you got out at 11:30. Awesome trade. Hey, fantastic, fantastic. Your commissions seem to be very low, John. I'll share with you what we do to get the lower commissions. I mean, we do get better commission rates from a number of brokers, and that's what I am using. So yeah, cost per trade is a thing, and commissions, keeping those low is absolutely something we want to do. Thanks, Brendan. One of the best traders I've come across in the whole net. Wow. Thank you. I appreciate that. All right. What else do we have here? Barb says, I think a lot of traders have accidentally sold instead of bought. I agree. I totally agree. I'm not a newbie, says Debbie. I did that a few weeks ago, but because of the market money math, the trade did not get away from us, right? That's a huge, huge, huge part of this. All right. What other questions do we have here? What is the average days to expiry that I will use when putting on a trade? Jerry, it's going to depend on the trend and the degree of pullback, but here's what I will say. The math usually works best with over 30 days. And we'll talk about in the class where the shift occurs, where the advantage goes away from the buyer of the option and to the seller of the option. I mean, there is actually quantifiable math that shows you where the seller of the options at the advantage under 30 days, under 21 days. Okay. And where we want to be is outside of that. But another thing that we do with market money math is we look at those events, those catalysts, and we oftentimes want to have enough time to expiration to take advantage of those events, right? So it's not just theta decay or time decay that we're concerned about, but it's also on the opportunity side. Do I have enough time to benefit from those scheduled events and the volatility that we would anticipate with those? All right. With options, there's not always the ability. So, Greg, that's a great point. Let me give you a really great example. So some of you wondering, Rog, we may not always be able to control that 50%. The Disney example that I showed you, and those of you that saw what happened to Disney after earnings, you guys saw that we had a dramatic drop in Disney. The options, for example, we got out, we took our $705, took our ball and went home, right? But if someone would have kept that, believe it or not, and this is what, and I was really looking at that to make sure, is that 50% control realistic? Greg, the options were right about 50%. Those options that we had bought, if someone would have, say, accidentally held them too long, or they decided to hold them through earnings, it was actually at that 50%. So it does take a dramatic amount of movement against the trend or time decay to really get us past some of these thresholds that I'm going to teach you in the class. All right. So, hey there, Debbie and Stevie B. How did I manage the Disney trade to make sure you did not exceed the 2.5%? So we spent about $1,000, $1,046 on that trade. And I was not going to let the trade move more than about $250 to $300 against us. And it actually never did, which is great. And the reason we were able to do that is we did the arithmetic from both the upper and lower levels of the zones. We took the lower level, right? So that gave us a much more risk-controlled entry, and then we got out by earnings. Okay. How do we find the Disney trade? Pete, that's going to be really 100% the bonus, right? We used the grab candles and the wave. We focused on, like in the example of Disney, we focused on a market that was predominantly green grab candles. We focused on uptrends. Use those indicators like grab candles and the wave to identify the best type of organized trends. Okay. So the candles are grab candles, gang. Yep, those are grab candles. Let me tackle a few more questions here, gang. And again, thank you so much for your time. The replay will be sent out to you. This was a 10K account. Greg was asking, what's the size of the account? 10K. It's currently sitting at $17,700 as of today's close. All right. And using just those two entries that are in the bonus, by the way, using the grab candles and the wave, very basic, just two entries that we were using, pullbacks and overbought, oversold fades. And we go over those in the bonus. How do you protect yourself from a gap down overnight? Vitaly, a lot of that's going to be looking at the calendar, looking at the different volatility events. So that's how we protect ourselves. And we also protect ourselves, like I mentioned, with the asset class. Yeah. All right, gang, let's take a few more questions and we will wrap this up. Again, thanks for all the questions here. How do you find your range? Karun, with the wave and the grab candles, again, upper and lower end of the range using those moving averages. But here's the key. You run the math on each one of those zones. Okay, you run the math on each zone. And sometimes you're going to find that the upper part of the zone is essentially unaffordable. It may be a great setup, but it may be something that doesn't work for your size account. For others, you might find, okay, Rog, I'm trading a $50,000 account or a $20,000 account, not 10. You might find that scaling in with smaller position, and we do the math on all this in the class, ask yourself, how much can I afford to enter at the top end of the range and not risk ruin and not risk that 2.5 to 3%? Can I even do that? And if I can't, we have to wait for a more affordable, or in this case, deeper correction. All right. So another great question, does the max risk grow with the account? Absolutely. as the account grows, now again, like 17.7, as I mentioned. So from May 30th now to August 8th, we're at 17.7 from the 10K. And remember, that included that first whoopsie trade, which actually cost $300. So does the max risk increase? Absolutely. So you can start to, as you gain momentum, you start to get more larger wins, right? And also you're able to risk more. So as your account grows, as your confidence grows, so too can your position size. And that's when you really start to gain some momentum, but you're never looking for those home runs, gang. Okay. All right. Just another question or two here, gang. We will wrap this up. Did you not make any trades in early June? Oh, we did, Karun, we did. The snapshots that I've showed you, yeah, we did make some trades in early June. Like I said, we started in May and we did make some trades in early June. Yeah, part of what we'll be doing in the class, gang, is going through those trades, talking about how they were built, why they were built, and some of the complementary symbols around them. And then once you understand the formulaic process by which we identify the entry zones, do the market money math on each one of those zones, and then learn how to go wide, not deep, then you absolutely can replicate this in any market. That's the great part of this. All right. Let's see. Ryan Fox says, if we build wide and spread the risk with the same sector, how much have we really spread the risk? Ryan, the reason we can do that is because we have trends. You're right. Are they correlated? Absolutely. You know, that's a question we get a lot. Wrong. These are correlated trades. They are, but they're correlated trend trades, right? So if I find uncorrelated trades, we can actually build them that way as well. Is there market money math for uncorrelated trades? You bet. You know, how do you find those uncorrelated trades? You understand the market money math behind weighting, ETF weighting, broader index weighting. So it really does break down to, if you do want to build uncorrelated, absolutely, the math is the same, my friend. And that's a great question. All right, so the class downloads will be available, the bonus download, the class downloads will be available. You'll get the login and everything, Jimbo. Yeah, they'll send that out to you. And if not, customer service will absolutely help you out. So again, simplertrading.com/math. Is there any special software we have to buy? Greg, no. No, in fact, you don't even have to buy any indicators. I'll be giving you guys the free indicators. Is the strategy class itself going to be recorded? Coop, if I'm on the mic, it's going to be recorded and available to you for whatever package you've bought. So yes, absolutely. You'll be able to watch the recording as much as you want at your leisure. All right. Full-time job? Tim, yes, my husband spends about an hour a day on this. About an hour a day. Are the candles different than Heikin-Ashi? These are grab candles, Gator. They're grab candles that utilize those 34 EMAs that I talked about, and I get into more detail in that bonus, the decoding swing trading bonus, and I explain why they shift color. And you watched how well they worked here in these examples, and they continue to. Again, that's the backbone of this account growth. Does the math apply to retirement? Lisa, yes. One of the things that we did last October, November is I reshuffled my personal portfolio to get long gold, bonds, and the dollar, and using the same math, just a longer time horizon. Absolutely. So yes, it absolutely does. Just the time horizon changes, right? You're still going to use your account size and run the math against that account size. Again, if your retirement account, it is, you know, whatever the number is, I'll just grab something arbitrary like 100,000. We'll just do the math on that size account and with that time horizon in mind. Absolutely. What else do we have here? What are the asset classes that I'm depending upon volatility in general? Tonafit, we trade ETFs, stocks within the ETFs, the broader indices, and futures. And I give you guys, for those of you that don't trade the futures contracts, when there are alternative ETF contracts, like for example, we had a great trade in corn in the account not too long ago. And instead of trading the ZC futures contracts, we traded the CORN ETF. And even better, we traded the options on the CORN ETF. Okay. All right. So we'll be sharing watch lists, the zones, the math for each zone, the math so you build a proper wide, not deep watch list. Absolutely. And all of it's recorded, Ben. So if you can't attend it on that day, you'll have plenty of time in between the live trading to catch up on the class or even review it. And so again, we put space in between each live trading day so we can just cover more market action, build a broader watch list, and discuss the trades without having to squeeze it in within, say 2 days consecutively, right? And that's what's so great about the Elite. We're really trading across 2 weeks in the Elite package, okay? All right, so is there a way to scan for trading opportunities? Samir, yeah, the grab candles, that decoding swing trading is how I scan across multiple charts looking for the right structure. I use those grab candles, all right? Okay, let's see. What's the best way to define or identify exhaustion? Mark, the grab candles, and let me give you a tip, look for blue grab candles. In fact, look for a mix of blue, red, and green. It'll change your life. And then you start adding the market money math to that, you'll absolutely be able to take advantage of CHOP. In fact, that's what we did in a roundabout way in McDonald's on Monday. Actually, McDonald's and Starbucks on Monday. All right. How do we make sure we didn't exceed 2.5%? Again, on that one Disney trade, we actually avoided sitting through earnings, gang. We avoided sitting through earnings because the math does not work if you're going to sit through volatility events like that. And we didn't need it, right? In fact, we would have given back all our profit and then some. Okay. Anything else here? I think we tackled that. So again, it is going to be recorded. And minimum account size required. Gang, I would say, I mean, look, there's probably not a minimum, but I think it's tough if it's below 5K. Like I said, my husband used 10K. You would basically cut everything that he did in a 10K in half. But if you have 20K or 50K, you do everything 2 to 5X. So personally, in my account, everything that happened in that 10K account, personally, I'm 6 to 10 times the size, right? So if you have a larger account, you can go larger, 6X, 10X. And if you want to go say 5K, I would just cut everything in half. Or some trades, you're going to have to wait for the better, more affordable money math range, or cut the trade altogether. But you're going to have to know what's appropriate for that account. And then once you crunch the numbers, is this trade affordable? How can I get a lesson on the grab candles, James? That's what the bonus is all about. The decoding swing trading, how to use the grab and the wave. The strategy class is 4 hours, gang, 4 hours. All right. And that's going to be on August the 17th from 11 to 3 Eastern. So we'll be getting together August 17 from 11 to 3 Eastern. And if you can't attend, it is recorded, gang. All right. And then the live trading days are the Monday and Wednesday for the 2 weeks that follow. So we have this on Saturday, the next Monday and Wednesday, and then the following Monday and Wednesday are the live trading days. So really, it's almost like a 2-week class in many ways in that regard once you get the Elite program. All right. Any other questions, gang? Customer service can help you out. All right. And all the information is at simplertrading.com/math. And I think we're good here, gang. So thank you so much for the time. And I will see you all out there. Best stick on the trend, gang. Best stick on the side of the trend. Be patient in this market right now. It's nice to be looking at the markets rebounding from Monday's sell-off, right? Think about those thresholds that we talked about in this class. You can start putting them to work tomorrow, and I think you'll start to see, even at that very basic surface level, you start crunching numbers, how much better it can get. When you start to find the levels within your entries, aggressive, moderate, conservative, looking across, building watch lists, wide, not deep, that's where this stuff really starts to shine. Okay. All right, gang. Thank you so much. And I will see you all in the class on August the 17th Thanks very much, BVN. It was a lot of fun to do. I appreciate that. All right, gang. Take care. And the replay will be sent out, by the way, shortly.